AUDAX is playing a high leverage game with a billion-dollar portfolio. Is the payoff worth the risk? The latest 8K filing from AUDAX Private Credit Fund provides a transparent look at their capital structure. At the center of this report is a massive investment portfolio valued at $1.047 billion. For the bull case, this represents a highly efficient, leverage-optimized machine for compounding shareholder value. By maintaining a 0.94 debt-to-equity ratio, AUDAX is strategically amplifying its returns. This allows them to capture floating rate spreads and private credit premiums while keeping a resilient balance sheet. The reported NAV per share of $24.82 reflects this institutional-grade credit origination. In a market where private credit outperforms traditional fixed income, this framework is a clear growth catalyst. However, the bear case rules a much more precarious reality hidden in the balance sheet. Consider the numbers: $536.2 million in senior debt against a total NAV of $569.2 million. This means nearly half of the fund's total asset value is offset by debt obligations. The equity cushion is remarkably thin, leaving almost no room for asset value declines. A modest 10% write-down in the portfolio could erase over 80% of the equity. Furthermore, the NAV relies heavily on Level 3 fair value inputs, which are notoriously subjective. Without third-party audit transparency, these marks are vulnerable to rapid de-rating during a credit squeeze. The fund's emerging growth status shields it from full Sarbanes-Oxley scrutiny, reducing disclosure depth. We have no clear insight into the nature of the $536 million in debt. Whether it is revolving credit or high-interest bridge loans, the rollover exposure to rising rates is a risk. The leverage-optimized debt narrative may simply be a veil for a highly leveraged, under-disclosed vehicle. For the investor, the tension lies in the trade-off between amplified yield and systemic fragility. If the credit cycle remains stable, AUDAX is positioned to capture massive market share in alternative credit. But if liquidity dries up, the thin equity cushion could lead to a rapid NAV collapse. The June 4th filing confirms the ability to deploy capital, but highlights the inherent leverage risks. Ultimately, this is a bet on the quality of the underlying loans and the stability of the macro environment. AUDAX has built a powerful engine, but the brakes are tested by a very thin margin of error. Whether this is a masterclass in efficiency or a gamble on liquidity depends on your risk tolerance. The numbers are clear: high reward, but the downside is potentially absolute. That is the reality of the AUDAX leverage strategy as revealed in the latest filing. A high-stakes game of credit and capital, where the margin for error is razor-thin.